Well, it's Michael again from Scottsdale, Arizona. It's the 4th of October, 2017. I didn't expect to be doing a video this quick, but goodness gracious, our forecast is unfolding right before our very eyes, and it's pretty important that we start to recognize this. And what I'm speaking of, we've been talking about the stock and bond market ad infinitum, saying that we have risk in the stock market, we have risk in the bond market. And just yesterday, the President of the United States, Donald Trump, who, as we all know, is a businessman, and he understands leverage. He's leveraged all his properties. I mean, he's built his things on loans and debt. He understands debt. He understands bankruptcy. He understands restructuring, and he understands default. Well, here's a really good financial guy. He goes down to Puerto Rico, and of course, Puerto Rico has been in the news anyway for a very long time because they've had so much financial trouble. Their poor governor has been up to Congress pleading his case and saying, "Look, you have these regulations saying I can't go bankrupt, but I can't pay my bills. So no matter what you call it." I had the choice of either paying the bondholders or paying for water and garbage pickup and schools and electrical for my citizens. So I choose my citizens. God bless him for that. But, whatever you call it, he can't pay his debts. So come forward here another year, and here's Donald Trump coming down after it's been hit by these hurricanes and just devastated. Donald Trump gets down there and he says, they have so many problems here. They have so much infrastructure problems, and looking at their debt should go away. Well, goodness gracious, here's the President of the United States who's almost giving permission to default municipal bonds. And as a consequence, Puerto Rico's bonds dropped like a rock today. They were in trouble anyway. I mean, they're not the greatest bonds in the world, but they're down to 35 cents on a dollar. So if you gave them $1, you can sell them for 35 cents. So that's not a really good return on your investment. That we like to work the other way around. So we buy for 35 and we sell for $1. So that's not really good. So how does that affect you guys? How does that affect my clients? Well, it's just part of the unfolding that we have, in that we know that the pension funds and those people who are relying on pensions, we have some really good clients, some really core good people that are with the fire departments and the police departments, with the municipals that have worked their lives. They've done careers. I mean, the Dallas Police and Fire Fund is in huge trouble. It's they're teetering. We have truck drivers and the Teamsters unions, their pension funds, like the Mid-States Pension Fund, has petitioned for bankruptcy. This is just a shot across the bow. So when you have Puerto Rico, let's go back to Puerto Rico. Puerto Rico has $75 billion in municipal bonds for infrastructure and for doing things for Puerto Rico itself. But what's not said is that they have $110 billion in unfunded liabilities. Most of that's pensions. So here's pension workers, people who are expecting to get paid. I mean, they're my age or older, and they've done what they were supposed to do. They did their job. They did a career, and part of their wage package was the fact that they had pension benefits. And when they get down to collecting, here they are. They're from Puerto Rico, and all of a sudden you have President of the United States say, I don't see how you can pay for this. These debts should be wiped out. Well, maybe it doesn't get put into a bankruptcy, but maybe it does. I mean, oftentimes what happens is that the municipalities will lump their pension obligations in with whatever their bond obligations are, because it's debt, and get relief from this. So this is just the tip of the iceberg. So if I were, I always pick on Illinois because they just got downgraded and they have so much debt, it's just unbelievable. And of course, the teachers union is I think it's over $100 billion in unfunded liabilities. $100 billion of unfunded obligations. The teachers are never ever going to get paid. I have a really good friend from the police department. And he gets 80% of his last year's pay. Well, okay, you have to know that the last year that they took all their sick pays, all their vacation days, they did all the overtime they possibly can, just stuff their salary with as much work as they possibly can so they get 80% of last year's pay. so that they get 80% of that for life. And then the poor municipality, the city, has to go out and replace them at 100%. So not only paying 80% for a retiree, a pensioner, now they have to pay 100%. So now their obligation went from 100% to 180%. So, and then we have thousands and thousands of baby boomers are retiring. And of course, 30 years ago wasn't a problem because they had 30 years of work before any of this started to happen. And now all the baby boomers are retiring, and they're asking for what they were promised, and there's no money for them. So my friends that are with the pension funds, you probably are not going to get everything that was promised to. So we need to do this what if game. What if you don't? So you need to start making preparations now. If you're already a pensioner, well, you need to start thinking. You need to talk to your financial advisor, start looking at the money that you do have, your stocks and bond portfolio, and thinking, man, if this gets hurt, I really need to start making my obligation. You need to get out of debt, and you need to start considering what's going to happen if I don't get my full pension. Now, if you're working, if you're a officer or fire department, fireman in their mid-40s, you need to start thinking, well, maybe if I don't get my pension, I need to start providing for myself. So that means I need to start thinking of a retirement plan, some other kind of IRA for myself, a KEO for myself, a SEPA, or some kind of real estate for yourself that you can count on for later on. So our clients, we need to start thinking of a couple things. First up, your stock portfolio, you need to talk to your stock, you need to talk to your other financial advisor and ask, at what point do we have an exit strategy? What's our exit strategy? And you need to ask, do I need to be fully invested all the time? Maybe you should take half of your money off the table and go to cash. Same with your bond portfolio. Bonds are at a double risk. They have not only a credit risk, but we also have a market risk because interest rates, when you start seeing that Puerto Rico is going to maybe not pay their bills, that puts on market risk. So as market risk goes higher, people want to get paid more. So interest rates go up. As interest rates go up, value of bonds go down. So you really need to recap your bonds. So take a look at that. And for my clients, we need to make sure that your core holdings are in really, really good shape. Now, our core holdings are those holdings that we're going to keep right through any downturn. These core holdings are meant to add up to our income. They are part of our cash flow component so that we can go ahead and run our life normally. So our core holdings are those that consistently give us a cash flow. And these are core holdings, are properties that always rent, and we want to keep because we think that they will probably appreciate in the coming years. Keep in mind that our review for our portfolio is 2023, 2024. So we're really not looking to sell too terribly much unless we have something that doesn't fit into your core holdings. We should all be at core holdings at this point. But what we want to make sure is that our cash flow is sufficient. So you need to review your cash flow and make sure that it's sufficient for yourself. If it's not, then you need to probably come in and we'll sit down and go over to make sure that it can. Now, remember, 70% of the wealth in the United States is held in stock portfolios. So I'm not saying we're entering a recession, but we're a long ways out into this business cycle. Business cycles always complete, and the completion is a recession. So the average recession is 39.6% loss in the stock market, just in a average one, and this one could be pretty bad because I think we're going to have so much. The world is just awash in debt. I mean, there's no way all this debt can get repaid. So once the defaults start, we need to just shelter down, and which brings us to the fact that not only do we need our core holdings, we need to make sure that we have a good reserve for ourselves, just in case we have something comes up that we didn't foresee. And also we need an opportunity fund, because as the if we do start to see a downturn in the economy, we're going to get some opportunities to buy some really good things probably at pretty discounted prices. So it's Michael. This is just a short video for today, and if we can help in any way, shape, or form, please do. You can call us here. You can call my staff. We're generally around, and we're more than happy to work with you any way we possibly can. And my very best to you.